So the first rule that Buffett has is you should avoid going too far afield when buying stocks. So you should avoid going too far beyond what you know. You shouldn't go just searching for stocks. You shouldn't just go searching for things that you have no understanding of. He says investors should make sure that they fully understand how a business operates, how it makes money, and the future sustainability of the business model and profits before buying a stock. And this would seem like, well, duh, don't you need to know what you own? Doesn't that make a whole lot of sense? Well, of course it does. And this really ties into a lot of things that Warren has talked about over time. He talks about investing a lot like hitting in baseball, like a lot like batting in baseball. And when you're at the plate, right? It's 3 strikes and you're out, right? At the old ball game, it's 3 strikes and you're out. And he talks a lot about how he saw this chart a long time ago, and it had Ted Williams at the plate. And Ted Williams, for those of you who don't know, one of the best hitters in baseball history, still to this day holds the record for the highest batting average in a single season. And Ted Williams was standing there, and there were little dots all through the strike zone, right? Through the zone through which if the ball goes through it, and that's a strike, right? There were dots on all different parts of the strike zone, and it just made this big rectangle. And there were 77 dots. Well, within each dot, it said what Ted Williams' batting average would be or was given where that ball would have been thrown. So if you throw the ball at a certain part of the strike zone, he might be hitting 330, but you throw it at another part, he might be hitting 220. And so Ted Williams would have to, from time to time, swing at pitches that maybe he wasn't good at hitting or didn't like very much, just in order to not strike out or maybe not get out at all. He would have to swing at things that were not his favorite. And Warren's analogy here is to investing. And that when you are looking for a stock to invest in, right, you can let as many pitches pass as you want, right? You can let as many opportunities pass as you want. If you didn't get in on Tesla this past year, it's okay. If you didn't get into, GameStop and AMC and all the stuff that's going on right now, then that's okay, right? If you missed those quote unquote opportunities, I don't know how much of an opportunity they were, but if you missed those, those wealth creating events in the stock market, then that's okay. What he's saying is in baseball, you have 3 strikes and you're out. But in investing, there are no called strikes, meaning, investments can pass you and you're never hurt by that. You're never punished for the fact that you let an investment opportunity pass. You let an investment opportunity pass. That's something that maybe you didn't understand well, or you didn't, have the full picture of why that would be a good investment, or you had some bias towards thinking something about that company, whatever it may have been. You don't have to swing at every pitch. And Warren's whole idea here is that you can choose to only swing at pitches that you like. And what are pitches that we like? Well, pitches that we like are things that we understand, right? Pitches that we like are things that we can put values on. Pitches that we like are things that we can look at the company's fundamentals. We can look at what's going on within a company and make a good determination on whether it is a good investment or not. And then, and only then, can we take a swing. Because even though there are no called strikes, as Warren says, you can swing and miss, right? But the whole idea is that you do not have to. You don't have to swing and miss when you invest, because you can keep watching things pass. If you have some uncertainty about something, you don't have to swing at it. And the thing is, investment opportunities in stocks, they come back around, right? Just because you didn't like it at a certain valuation doesn't mean you won't like it at another valuation later. If you didn't think it was a good opportunity now because of the management, maybe the management changes later and it's a good opportunity to buy. But this is such a key rule. It's such a key rule to understand what a business does, to understand what they are about, how they make money, what their management is about, how they are going to grow into the future before you ever decide to make an investment decision. And that is what Warren calls his circle of competence. Now, this kind of goes against the idea of diversification, because Warren over time has talked about how you really only need about 6 to 10 good stocks over the long term to make a good career out of stock picking. And he's not a huge, I'm not going to say he's not a huge fan, but his individual stock picking is not the most diversified stock picking. Why is that? Because he is picking stocks that he understands, and that is within his circle of competence. So a lot of those companies can fall into similar industries. They can make money in similar ways. But obviously he understands diversification and obviously runs a conglomerate of a company in Berkshire Hathaway that is constantly acquiring new companies and diversifying their portfolio even further. So there's that as well. But he's saying for an individual, maybe diversification is not that big a thing when you're picking individual stocks. Stay within your circle of competence and you will be best served over the long term. So I think that is a great first rule to follow. And it's really intuitive. All of these are really intuitive. But if you really think about it, it really brings you back down to earth as an investor. This first rule does. It brings you back down to saying, okay, I don't need to worry about all these things going on where huge returns are happening and I'm not a part of it. And I don't need to get this fear of missing out, this FOMO, right? I don't need to fall into that place. I need to, control what I can control, understand what I can understand, do the work, realize that if I'm going to buy individual stocks, which not everybody should buy individual stocks, if I buy individual stocks, I need to do the homework. I need to understand what the company does. And then and only then should I go about making a purchase. And this extends even to fund investing, right? If you're buying index funds, mutual funds, whatever it is, you need to understand whatever you invest in. It doesn't just have to be an individual stock. You have to understand what a mutual fund does. You have to understand what an index fund does. Because if not, and I've talked about this before, is that we can get afraid. Our risk aversion, right, can seem a lot higher just based on us not understanding something. A lot of times if we just understand what we're going into, then our ability to take on the risk inherent to whatever that is will be much higher because we're like, oh, well, I know what this is. I know what this does. I'm not worried about this amount of volatility it has, because typically if you don't understand something and it starts to go down in value, that can really, get the chest tight and make it hard to breathe and like, oh man, I don't know if that's a good, and that's when you see a lot of people trade in the short term. It's not what we're trying to do. Understand what you're going to invest in and you will be best served.